So in our last video, we talked about how much life insurance you need. Now you have a number in your mind. You know what most people have told me over the years, Lance, I don't object to life insurance, I just don't like paying for it. I couldn't agree more. 2 or 3 times a year, I get a phone call from a reporter doing an article and they want to talk to someone in the industry. And because I have some expertise in life insurance, they always say, what's the best type of life insurance to buy? And I have a standard answer, the type that is in force when you die. I'm going to talk to you about the different types of life insurance policies that you can buy. They have different cost structures and different features. And the role of a licensed insurance agent is to figure out the right plan for the right time in your life. And sometimes you need to switch plans because your life changes. So the first plan I'm going to talk about is something called term insurance. And the reason it's called term insurance is it goes for a specific period of time. Terms tend to be 5 years, 10 years, or 20 years. And so I'm going to use an example of 10-year term insurance and a 30-year-old that buys a policy. So what happens, a life insurance policy is one of utmost good faith. And what that means is the insurance company wants to insure known risks. So there's an underwriting process. So the insurance agent and yourself sit down and they ask you a series of medical questions. If you say you're a non-smoker, you're a non-smoker, you don't have high cholesterol, those sorts of things. Then the policy gets issued. And if it's 10 years, the rate is set from age 30 to 40. And then in Canada, when a term policy gets to the end of the term, it renews. But here's the thing. The odds of someone dying between 30 and 40 are low. The odds dying between 40 and 50 increase. So every 10 years, the annual cost structure increases. And the way a term insurance policy is written is the policy goes through to age 80 and then it terminates. And sometimes clients have said to me, so I got to die to win? And I say no. It's kind of like car insurance. You pay your car insurance. If you don't get in an accident, that's a good thing. But if you did have an accident, you were insured from the financial risk of a car crash. Well, you've got life insurance. If you don't die in the year, I consider that a good thing. But if you did die, the life insurance is going to be paid tax-free to whoever the beneficiary is. So it's called renewable and convertible. So what does the renewable mean? It means at age 40, the insurance company is obligated by contract to renew the contract for another 10 years. But here's a little concept in insurance. It's called anti-selection. Life insurance is inversely related in importance to your health. So what does that mean? Well, if I bought it when I'm 30 and I'm 40, I just finished a triathlon, I have 9% body fat, and I don't smoke or drink, I'm gonna have no problem buying a new life insurance policy. But if I'm 50 pounds overweight, I'm smoking, I got high blood pressure, and I've had a TIA, there's probably a good chance I'm not gonna be able to get life insurance. So I'm gonna keep the renewal. And so what insurance companies know is at renewal, healthy people go and buy new life insurance elsewhere, and unhealthy people keep it. And so the renewal rate is significantly higher than current market rates. But if you can't buy it, it's still a good rate. And so part of our job as an insurance professional is to be comparing your rates to what's in the marketplace. And if you're healthy, to consider switching. The death benefit on term is level. So what it is, it's a level death benefit with an escalating cost over time. The next type of life insurance is some people don't want life insurance that goes to age 80. They want it to go out to age 100. In fact, now it goes to age 110. It goes for the whole of your life. So this type of life insurance is called whole life, also known as ordinary life and sometimes known as straight life. And instead of having escalating premiums, you pay a level premium for life. And the way it's designed is in the first number of years relative to the cost of term insurance, you're paying significantly more in premium than the true risk for the death benefit. Why do you do that? So later in life, you can pay significantly less. So what does the life insurance company do with that overpayment of premiums? Well, there's 2 things. One, they take it and they invest it. They invest it in the stock market, in mortgages, in real estate, in bonds. And the reason they do that is they have to let that money grow so they have enough money in reserve to pay the death benefit in the future. Because with a whole life contract, if it's not canceled by the insured, it has a 100% payout ratio. Term insurance has a 2% payout ratio. Why is that? Because most people don't die when they're young, so they can buy a lot of life insurance inexpensively. But then when they get older, it gets prohibitively expensive and they let it lapse. Term insurance is a great product, but it's also wildly profitable for the insurance companies. So coming back to the whole life, each year they pay a dividend on the excess that you paid into the policy. And what most people do, there's a number of options, but what most people do is buy something called paid up additions. That's little amounts of life insurance wholesale. And these get added to the base plan. So what you have is you have a level premium with coverage that goes to age 100, and the death benefit increases every year. Now, life happens. Let's suppose in 15 years you said, I need to cancel this policy. I can't afford it. My life circumstances has changed. That overpayment of premiums is called the reserve or the cash surrender value. If you cancel the contract, the life insurance company returns the cash surrender value to you. When you get to retirement, you can have a significant reserve built up. And you might say, I don't need that much life insurance. And you can get the life insurance company to pay out to you tax-free in your retirement some of the reserve from the life insurance. It protects you when you're alive, and it can protect you in retirement. Now here's the difference. For a 25-year-old, $1 million of 10-year term insurance might be $30 a month. $1 million a whole life might be $1,200 a month. So the question is, which policy should I own? I said the one that's in force when you die. $1 million a whole life and $1 million of term both pay out the same amount. But the reality is even though many people like whole life, when they're young and they've got lots of obligation, term makes the most sense. Whole life comes into the picture when people have done well financially in life and they're gonna need to pay taxes or they wanna leave charitable bequests. There's a third type of life insurance, and it's called term to 100. It's a combination of term and whole life. It's a life insurance policy that goes to age 100. The premium is level and the death benefit is level. So in term insurance, the death benefit is level and the premiums increase. In whole life, the premiums level and the death benefit increases. So you can see how it's a combination of the two. But the thing about term to 100 is if you were to cancel the policy in the first 20 years, most companies, not all, there is no cash reserve, even though you've paid a premium for 20 years. So when you buy T to 100, you want to make sure you're going to keep it for the duration, because if not, you're better off getting term or whole life. But there's some very specific situations where term to 100 makes a lot of sense, particularly in estate planning where you have business owners that have done an estate freeze and they have a finite tax liability. They buy what's known as a joint and last to die. So there's your three types of life insurance: term, term to 100, and whole life. If you have any questions, you can click on book an appointment with me and I'd be happy to have a 15-minute chat with you. Thanks. Talk to you soon.